Hi, this is Kizzi and welcome to our video offering you advice and insight on successful property investment strategies. Business Game Changer TV spoke to a number of hugely successful property specialists and asked them one question. What one piece of advice would you offer our viewers that would really help them make the most of their property investment? The result? Well, it's certainly given me a lot of food for thought, and I'm sure it'll give you some great ideas too. The advice given in this video relates specifically to Australia and the UK, but if you're outside of these regions, I'm sure there'll be some common threads that you can apply to your part of the world. This video has been brought to you in association with our luxury property portal, Kizzi's Luxury Properties, the best place to buy and sell a luxury property. You can visit Kizzi's at www.kizzis.biz. Oh, and don't forget, if you enjoy this video, please like and subscribe and post a comment in the comment box below. We'd love to hear from you. Now, on with the show. Get a pen and paper handy, put your feet up, put the cat out, and happy viewing.
Hi, my name's Amelia Harris and I'm the General Manager of My Property Circles, Australia's go-to destination for investing in property with friends, family and like-minded investors. Many of us don't have enough of a deposit or borrowing capacity to invest in property solo, so we have come up with a way of pooling your resources with others, sharing the risk and the reward of property investing. Why this is important at the moment for property investors, you ask? Well, as conditions in Australia's property market continue to tighten, many buyers are looking to get their foot on the ladder sooner rather than later. Teaming up with others and purchasing property together can be rewarding for all types of investors. My Property Circles not only provides you with a trusted structure, it can also put you in touch with many experts well versed in property investing with others to guide you through the entire investment process. Although there are no guarantees of success, there are ways to minimize the risk involved and maximize your chances of a great result. And at any time we say, beware of the risk, but keep your eye on the prize and your end goal, which will hopefully help you enjoy a strong profit and that can be leveraged in future investments on your own. Owning a percentage of something is better than owning 100% of nothing.
My name is Bellesini from undercoveragent.com.au. I'm the author of Why Many Agents Lie and How to Keep Them Honest, and my business helps homeowners and property investors to select the best agent to maximise their sales price. I dive deep and interview agents on my clients' behalf and ask and test agents to see if they have the skill to back up the promises they make prior to listing. I've been involved in real estate since the mid-2000s, and I'm a licensed real estate agent, accountant, and most importantly, worked as a property developer's personal assistant on over 100 sales. My advice is select your real estate agent carefully. Just because they've sold a lot of homes in the area or sell above reserve or even come highly recommended does not mean they are maximising your bottom line, which after all, as an investor, is what you are out there to do. Often investors do all the hard work, present their home the best way to try and attract the highest price, but then are let down and leave money on the table by agents' practices. The market in most areas has been so good for so long that real estate agents have gotten away with seemingly good results, often without much skill. As an investor, you want to make sure you are paying a fair commission to the agent so they are motivated, but also understand your property helps them to get more listings, so they'll definitely have room to move with their fees. Also understand that the marketing does not always help sell your property, but helps to brand the agent. So one of my processes is that I pick apart the marketing to make sure it is highly targeted to sell my home or my client's home. I would argue that anything in print except for a brochure this day and age is not necessary, and things like Facebook is not where buyers are shopping for homes. The hidden expense that can hurt a homeowner or investor is a poor strategy. Auctions cost vendors tens of thousands of dollars, so all they do is get one bid above the second highest offer. What you want is a skillful agent to go through a private sale process and extract the very best price from each buyer. In summary, whether you have never sold a home before or have sold dozens, having an expert on your team like myself adds huge credibility when dealing with your agent, as well as someone to bounce offers off. It takes away the stress and also keeps them accountable through the campaign. If you want to maximise your sales price, this could even be the most important decision through your investment journey. I hope these tips have been useful. Thanks for listening. I'm Chris Bellesini. Bye for now.
Hello, this is Bernadette Janson from the School of Renovating. We're based in Sydney and we help women replace their income with renovating, either straight away or in preparation for retirement. So I want to talk about how to choose a buyer's agent. It's important that you get the right person because you're going to be entrusting the buyer's agent with spending hundreds of thousands of dollars on your behalf. You want to make sure the outcome is good. So 3 main areas I would look at. Firstly, how familiar they are with your location and strategy. Secondly, their level of integrity. And thirdly, their fee structure. So in terms of strategy and location, these are really critical. So for instance, if you are wanting a property to renovate, you want to know that that buyer's agent has an understanding of the nuances of a good renovation project. And just by asking them what they think you should be looking for will give you some insight into their level of understanding. You might also ask them what education they've done in the area. Knowing the area, the location intimately is also really critical because that's one of the reasons you use a buyer's agent, so that you sort of make up for the shortfalls in your knowledge level, and also so that you're working with someone that has good relationships with the local agents. So the buyer's agent should be able to help you navigate, not buying in a no-go zone. So where the best pockets are for purchasing good properties, but also if they have good relationships with the local agents, they will have access to off-market deals. And that's one of the amazing benefits of working with a buyer's agent. The next thing is their level of integrity. So one, you want to check that they're licensed, but you also want to ask how they operate, and in particular, if they accept commissions from any of their suppliers. Not that that's a deal breaker, but you really do want to know when they're making recommendations to you, whether there are any other factors that might be influencing those recommendations. And then the next thing is the fee structure. So commonly a buyer's agent will charge like a deposit or a retainer, and then will charge a percentage of the purchase price, which can be anything between 1 and 2%. Some, I've even heard of some at 3%. So initially you want to know how long the contract is live for. So if you don't find a property in the desired amount of time, what happens? And get really clear about what your commitment is to that buyer's agent. And lastly, like anything, please do some due diligence. Try and talk to someone who's bought not one but several properties through that buyer's agent to get an understanding of how well they operate and how good they are. But also do a Google search of their company and see if you can find some reviews. I hope this is helpful.
Treating a property investment like a business is a mindset that sees successful property investors increase the value of their portfolio and secure considerable tax savings through depreciation schedules. With strategic and forward-thinking management, investors can build wealth and financial security. The ultimate goal as an investor is to cement a profitable and solid portfolio that grows wealth faster to fund your lifestyle. With big dollars at stake, it's wise to treat this form of wealth building seriously. From not doing regular maintenance or due diligence on property managers, investors are throwing away thousands of dollars in capital gains and rental income by not treating their portfolio like a business. One of the keys to growing the value of your property portfolio is is to have a rolling 10-year strategic plan and a great property management team to implement this plan. By mapping out your investment journey, you can protect your property portfolio, increase your rental income and maximise profits, and save thousands in tax depreciation and increase capital gains. If you had a business that wasn't profitable, how long would it last? Not long. Yet property owners happily hold on to poor performing properties with property managers who don't do anything to enhance rental income or sales value. If you've got a property manager who just collects rent but doesn't focus on your wealth goals or plan for the future, you need to ask yourself, what's the cost of not changing to a better property manager? You need one that has a plan for you. Working with property managers who only do the cursory inspections, minimum service, and fixing only what's broken is not going to help increase the value of your asset. It's essential you are always in the best position to get your property leased for maximum rent, to release equity, or sell for a premium. Your growth plan should encompass clearly defined goals around the property. For example, your occupancy aims, generating passive income, holding, selling, developing, and benefiting from tax depreciation and capital gains. Forward-thinking, proactive property management is key to growing the value of your property investment because it looks at all aspects of your property, from carpets, kitchens, bathrooms, floor, walls, and evolving market trends and expectations, anything that would impede the value of your property. A great property manager partners with you at every interaction to increase your rental income and the value of your property. To deliver this promise, it's vital they guide you with both maintenance and growth. This is where a solid maintenance and growth plan gives you, as the investor, a complete 180-degree from reactive to proactive property management. By focusing on the key elements of protection, growth, and profit, you will protect and enhance your investment and secure a reliable rental income. By having a well thought out plan, property investors know what needs repairing, upgrading, or replacing, so when the property is vacated, they're not up for a big spend and the property is always meticulously maintained with the most modern features that tenants look for. Wealth creation doesn't happen in isolation. Successful businesses ensure they have a team of experts on hand to help with different areas of business. They engage specialists who help with marketing, finance, admin, sales, and industry expert advice. You need a great team on your side. After all, these are the people who are going to help your asset grow. From a great accountant to a dedicated property manager and leasing managers, access to the principal, an extended network of trusted referral partners, including tax depreciation specialists, mortgage brokers or private bankers, and tradies. Having the right people on your team is an investment in your property value's growth, for which you'll get the best return on investment when you choose your property manager as wisely as you choose your investment property.
Imagine investing all your capital to build a property development. You're confident that they'll sell quickly, it's in a good location, everything's gone really well with the build. But now that it's time to sell, you're not getting any offers. And the feedback from the real estate agent is that the buyers believe the place has bad feng shui. You find out that there's no easy way to fix this without spending a lot of money, and no way that you'll be able to get your money back. This is the real story of a developer who had no idea how important feng shui is to so many people, especially the Asian demographic. And unfortunately, this guy lost everything. My name's Jane from Feng Shui Concepts in Sydney, and I'm here to share one of the big mistakes that property investors make, and that is ignoring feng shui. I help people get their design right and avoid making expensive mistakes that can turn off potential buyers. These are mistakes that people can see just by looking at the property online without even setting foot in the place. Now, back to the developer in the story, and the big feng shui problem with his property was that the staircase faced the front door. And from a feng shui perspective, that's considered bad luck because money quickly runs out the door. And that's certainly what happened for this developer. Quite often there's no easy way of fixing something like this. after a property has been built. Now, there are so many Feng Shui principles to be aware of, and there's also a lot of confusing and misleading information out there on the internet. And I do see many properties being selected and built without considering Feng Shui, and that can really cost property owners a lot of money. There are so many people who believe in Feng Shui and will pay a premium for a property that they believe will bring them good luck. So, if you want to select a good property, get the building design right, and maximise your property value, speak to a Feng Shui master. I'm Jane from Feng Shui Concepts in Sydney, wishing you the best of luck with your property investments.
Hi, I'm Jatin, CEO of Shojin Property Partners. I'd like to give you a few tips about investing into the UK real estate market. Now, previously when people thought about investing into UK real estate, they were thinking about buying individual units and apartments. However, over the last few years, the returns have been driven down with increased hassles of managing the costs and keeping up with the regulations. But there is a better way. Online investment platforms like Shojin have increased the number of ways people can invest into the real estate sector. These platforms enable fractional ownership across a range of investment products, so you can diversify your investments and take smaller stakes in various products. And because you're investing directly into the projects, you end up cutting out the middle layers of fees, and more of the returns come directly to the investors. There are three broad types of investments. There are asset investments where you're investing into yield-producing assets, a little bit like investing into an individual apartment, but rather than one apartment where you've got a lot of competition and the yields are very low, these platforms negotiate deals when buying entire blocks like student accommodation or a block of rental apartments. And because they negotiate a better deal, more of those returns flow to you. You get a running income from the rental income. You'll get a regular dividend from that. Plus, you get to share in the capital uplift of the asset as a whole. So you should be achieving about 5% running and about 15% per annum overall returns throughout the life of the project. Then you can also lend to developers in the UK. You can lend as senior first charge loans like bridge lending, where you can earn 6 to 8%. And the risks are fairly low. Then you get mezzanine investments, where you're in a second charge position sitting between the senior lender and the developer's equity. Slightly more risk, but the returns tend to be around 15%, and you're cushioned by the developer's equity and all the profits in the project. So that's a very good risk-return balance. And then you get the third area is really development equity, where you're investing alongside developers to share the profits from the project, where you can earn returns of 20 to 25% per annum, but bear in mind you're also sharing the full risks of the project. There are various ways to invest into the market through these online platforms, but there are some fundamental things to look out for. There's a lot of platforms out there. The first thing, if you do nothing else, just make sure that they are FCA regulated. Being FCA regulated isn't a guarantee a way of ensuring success. But what it does mean is that somebody is looking at these platforms and ensuring that they adhere to certain controls internally. There are a lot of charlatans out there, a lot of people who will be quite happy to take your money and spend that money on something completely unrelated. So whatever happens, make sure you're dealing with an FCA regulated platform. Once you've done that, there are several other things to look at. How are they doing their due diligence? What kind of team do they have? Do they have the right kind of experience? And what is their track record? How long have they been in the market? Also check if they're putting their own money into projects and how they're charging fees. Do they charge big upfront fees, or are they sharing profits at the end? A good platform should be aligning their interests with investors and making the bulk of their revenues at the end of the project. And finally, if in doubt, give them a call or actually go and see them at their offices. Any good platform will be very happy to receive visitors. Online platforms have revolutionized the way we can all invest into property, and it's definitely worth allocating some of your portfolio here. Just do your research and make sure you understand the risks involved. This is an illiquid market, and your money may get stuck for longer than you anticipated, or you could experience a loss of capital. Just remember that diversification is your key, and always start with investing smaller amounts until you're comfortable.
Good morning, my name is Kirk Simpson. I'm the director of the Lucra group of companies. We're a property management expert, a sales expert and a development company. I'm speaking to everyone about how to successfully invest in property, specifically in Australia, which is where we specialise in. My background is that I've been in property since day dot. I was taught by my grandmother, who'd been through 2 world wars and the Great Depression, on how to build a recession-proof property portfolio. And I think this information is greatly important, because we get clients all the time that have set up their portfolio incorrectly, and all they end up doing is selling it off, most of the times at a loss. A bit more about me is my grandmother helped me retire financially at the age of 26. I've had a lot of clients who have retired financially as well, that I've helped build their portfolio. And the key is, because you hear, there's all trends that come through. Every decade there's a new trend in property that comes through. And most of the time, for example, at the moment, most of the buyers agents we speak to, they're all telling their clients to get positively geared cash flow properties, and that's great. But cash flow, positive cash flow properties alone won't give you a successful portfolio. And the reason is because growth will always outdo cash flow. So the trick is to have a balance. So I can tell you my exact process is I buy properties in good growth areas, and then I use cash flow from commercial rentals to offset the portfolio's costs, and then bring it to a neutral position so that I haven't got any money coming out of pocket. And then I just pay it down, and I just keep repeating the process. So for example, I might buy a house 15 k's from the centre of Melbourne CBD. I'll try and make it as positive cash flow as possible. And then I'll buy a medical centre or a childcare centre. Now, the beautiful thing about a childcare centre is that it's government backed, it's recession proof, you can do leases sometimes for 40 years, it's a 10 to 12% return, and the tenant pays for everything. All you have to do is have insurance and just make sure that they're conducting their business as well as they can. That's the key to building a successful investment property. Buying just cash flow properties won't work, because most of the time I see clients just spend the cash flow on positive cash flow properties, the excess that they have, never putting any money back into the property or paying it down so that you pay off a house. And down the track, when it gets to the 7 or 8 year mark, the repair costs alone and the maintenance will outweigh what you've gained in cash flow. And then I've seen the reverse, where we've taken care of some of Australia's CEOs of major corporations that can't continue to take care of their own portfolio because they've just bought growth properties and have very little cash flow apart from their own income to support it. So you need multiple streams of income to have a successful investment portfolio, and that's where the commercial properties come in. Thanks for your time. Bye.